3,000 years before compound interest had a name, Jewish farmers were already practicing it, not with money, but with dirt. Every seventh year, the Torah commands something that would make any modern economist nervous. Stop working the land. Don't plant, don't prune, don't harvest. Just let the soil sit there and do nothing. The Hebrew word is Shemitah, release. And if you asked a farmer in ancient Israel why he was watching his neighbors in Phoenicia squeeze every last shekel out of their fields while he sat on his hands, he'd tell you something that sounds a lot like the best investment advice you've never followed. The land that rests produces more. Turns out the ancient rabbis understood something that most people scrolling through their brokerage app at 2 a.m. still haven't figured out. The most powerful thing you can do with your money, the single most wealth-building, life-changing, legacy-creating move available to you, is to leave it alone. Today, I'm going to show you exactly why doing less with your money often means ending up with dramatically more. And I'm going to use a mix of 3,000-year-old Talmudic wisdom and hard, current market data to prove it. Because the truth is, the Torah and the S&P 500 agree on a lot more than you'd think. There's a quote attributed to Einstein, and look, whether he actually said it is debatable, but the math behind it isn't. That compound interest is the eighth wonder of the world. The person who understands it earns it. The person who doesn't pays it. Here's what that looks like in actual dollars. If you put $10,000 into a broad index fund tracking the S&P 500 and you earned the historical average annual return of roughly 10%, and you did absolutely nothing else, no additional contributions, no clever trading, no watching CNBC until your eyes bleed. In 30 years, that $10,000 becomes approximately $174,000. You added zero. The market did the rest. Your money made money, and then that money made its own money, and then that money's money started a little side hustle. That's compounding. Now here's where it gets beautiful. If you added just $200 a month on top of that initial $10,000, still at 10%, you'd end up with roughly $630,000 after 30 years. Your total out-of-pocket contributions? $82,000. The other $548,000? That's pure compound growth. That is your money resting, regenerating, and multiplying while you went about living your life. The Talmud in Bava Metzia teaches that a person should divide their wealth into three parts: a third in land, a third in business, and a third kept liquid. This was written almost 2,000 years before Harry Markowitz published Modern Portfolio Theory and won a Nobel Prize for essentially the same idea. Diversify and let each portion do its work over time. The rabbis didn't have spreadsheets. They had centuries of observation about what happens when you respect the rhythm of growth, which always includes periods of rest. So if the math is this clear, why does almost nobody actually do it? Because your brain is running software that was designed for the savannah, not the stock market. Behavioral economists call it loss aversion. Daniel Kahneman and Amos Tversky proved that losing $100 feels roughly twice as painful as gaining $100 feels good. So when the market drops 8% in a week, and it will, regularly, because the S&P 500 has historically experienced a correction of 10% or more about once every 18 months. Your brain screams at you to do something. Sell, move to cash, buy gold, panic, anything but sit still. And this is where the concept of Shabbat becomes genuinely financial advice. The commandment isn't just rest, it's stop creating, stop intervening, stop trying to control the outcome. There's a concept in Jewish thought called bitachon, deep trust. The belief that after you've done your reasonable work, you release the outcome. It's not laziness, it's the opposite. It takes more discipline to sit with discomfort than to react to it. Fidelity once did an internal review of their best-performing customer accounts. You know what those accounts had in common? The account holders were either dead or had forgotten they had the accounts. I'm not making that up. The best investors were the ones who literally could not touch their money. The rest that Shabbat teaches isn't about doing nothing. It's about trusting the process you've already set in motion. Let's talk about where we are today, because this isn't just philosophy. The numbers are speaking. As of early 2026, the S&P 500 has just completed 3 consecutive years of double-digit returns. 26.3% in 2023, 25% in 2024, and 17.9% in 2025. That kind of run has happened only 5 other times since 1945. Now that doesn't mean next year will be negative. History actually shows that momentum tends to carry forward more often than it reverses. But here's what it does mean. If you pulled your money out during the nearly 19% drawdown the S&P experienced in the first half of 2025, which plenty of people did, you missed the almost 39% surge that followed. You tried to be clever. The clever move was to be still. Meanwhile, inflation is cooled to 2.4% as of February 2026. Core inflation sits at 2.5%. It's not at the Fed's 2% target, but it's in the neighborhood. And high-yield savings accounts are currently paying between 4 and 5% APY. That means your emergency fund, the money you're supposed to keep liquid and safe, is actually earning a real return above inflation for the first time in years. Your cash is literally growing while it rests in an FDIC-insured account. There is a Yiddish proverb my grandfather used to say, Geld is kelechtig. Money is round, it rolls away. But the flip side is also true. Put it somewhere stable, give it gravity, and it accumulates. The trick isn't finding some brilliant trade. The trick is setting up a system and then getting out of its way. Let me give you something concrete. I call this the Shemitah framework, and it's built on the same principle as the sabbatical year. Work hard to set it up, then let it rest and regenerate. Step 1. Your foundation. Before you invest a single dollar in the market, you need 3 to 6 months of living expenses sitting in a high-yield savings account earning 4% or more. This is your Shabbat money. It doesn't hustle. It doesn't chase returns. It just sits there, quietly compounding, waiting for the emergency that statistically will come. A job loss, a medical bill, a car that decides it's had enough. Right now, with top HYSAs paying up to 5%, this foundation isn't just safe, it's actually productive. The national average savings rate is 0.39%. If your money is sitting in a big bank earning that, you're not saving. You're slowly losing purchasing power. Move it. Step 2. Your growth engine. Open a brokerage or retirement account and set up automatic monthly contributions into a low-cost S&P 500 index fund or a total market fund. The expense ratio should be 0.1% or less. Vanguard, Fidelity, Schwab, take your pick. Then set it and do not touch it. Don't check it daily. Don't watch the financial news like it's a playoff game. The S&P 500's average annual return over the last 30 years is about 10.4%, including reinvested dividends. You're not trying to beat the market. You're trying to be the market, patiently, over decades. Step 3. Your sabbatical layer. This is the part most people skip. Once a year, I like to do it around the Jewish New Year, Rosh Hashanah, because the symbolism is too perfect. Review your allocation. Are you still diversified? Has your life changed? Did you get a raise? If yes, increase your automatic contribution. Then close the laptop and go eat some apples and honey. The annual rebalance is your Shemitah check-in. You worked the field for 12 months. Now assess, adjust, and rest again. Let me hit you with the counter-argument, because I know what some of you are thinking. But Rabbi, what about active trading? What about crypto? What about the guy on social media who turned $500 into $50,000 in a week? The data is merciless. According to research from S&P Dow Jones Indices, over a 20-year period, approximately 93% of actively managed large-cap funds underperformed the S&P 500. 93%. That means the professionals, people with Bloomberg terminals and MBAs from Wharton who do this all day, almost all of them lost to the index. And they charged fees for the privilege of underperforming. And the retail day traders? A comprehensive study out of Brazil, one of the largest ever conducted on day trading, found that 97% of those who persisted for more than 300 days lost money. The more they traded, the more they lost. Activity was not the friend of returns. Rest was. The Talmud in Pirkei Avot says it plainly. Who is rich? The one who is satisfied with their portion. It sounds like a moral teaching, and it is. But it's also an investment strategy. The investor who is satisfied with market rate returns, who doesn't chase every shiny new thing, who doesn't try to outsmart millions of other participants, that's the investor who actually ends up wealthy. Not flashy wealthy, quietly, deeply, generationally wealthy. Here's the final piece, and it's the one that ties everything together. $100 invested in Berkshire Hathaway in 1965 would be worth approximately $6.1 million by the end of 2025. That same 100 in the S&P 500 would be worth about $45,500. Both are extraordinary. Both require the exact same thing from the investor. Patience that borders on stubbornness. Warren Buffett didn't build his fortune by trading. He built it by buying and waiting. His entire philosophy can be summarized in one sentence that sounds suspiciously like something from the Talmud. Find something good, pay a fair price, and then do nothing for a very long time. The word for the Jewish concept of resting on Shabbat, menucha, doesn't actually mean the absence of activity. It means a state of harmony, of completeness. It's the kind of rest that comes after creation, not instead of it. You build the system, you fund the accounts, you set the automation, and then you enter menucha, the productive stillness where compound growth does what no amount of frantic trading ever could. Your money doesn't need your anxiety. It doesn't need your hot takes or your Reddit research or your cousin's cryptocurrency tips. It needs time, consistency, and the one thing most investors refuse to give it, the permission to sit still and grow. Shemitah teaches that the land promised to produce so abundantly in the 6th year that it would sustain through the 7th, the 8th, and into the 9th. That's a promise built on faith, yes, but also on agricultural science that the ancient world understood intuitively. Soil that rests regenerates its nutrients. Money that compounds regenerates its value. And the person wise enough to trust that process? They inherit a harvest that outlasts them. So here's my blessing for you, and I mean it in the most financial and spiritual sense possible. May you have the courage to let your money rest. May you resist the urge to check, to tinker, to panic. And may you wake up in 20, 30, 40 years to find that the most productive thing you ever did was nothing at all. This is Rabbi Eli Goldstein. That's the Torah of money. I'll see you next time.